Welcome back to the Forex Lounge Fundamental Extras. Today is Wednesday, May 19th, 2010. Welcome back, one and all. Great you could join us. Today, Bloomberg.com reports the cost of living in the U.S. unexpectedly dropped in April for the first time in more than a year, reinforcing forecasts that the Federal Reserve will keep interest rates near zero for much of 2010. The 0.1% fall in Consumer Price Index was the first decrease since March 2009. Figures from the Labor Department show today in Washington. Excluding food and fuel, the so-called core rate was unchanged, capping the smallest 12-month gain in 4 decades. Getting to the charts to see what this looks like, the blue line represents the U.S. Consumer Price Index. That's a blue line, again dropping to negative 0.1%. These are levels that we have not seen going back to March of 2009, and it is also below its own 12-month moving average, which is the violet line. Now, as the CPI increases, when it does increase, this gives the Federal Reserve more reason to raise interest rates. Higher interest rates lead the market to believe that the dollar will go up and we buy the dollar. However, as the Federal Reserve does not raise interest rates with the CPI dropping, this leads to weakness in the U.S. dollar, as there's not an anticipation that the Federal Reserve will raise rates anytime soon. Compare the U.S. CPI, that's the violet line in this case, to the Dow Jones Industrial Average. Now this, of course, is based on monthly charts, so it does not reflect the recent drops in the Dow Jones Industrial Average. So the Dow for the month of April closed around 11,000. At that time, the CPI was a little bit higher than it is now, but now that we can see that the CPI is dropping, historically, as the CPI goes down, the Dow Jones Industrial Average tends to go down. When the CPI goes up, this tends to reflect a stronger economy, and therefore the Dow Jones Industrial Average goes up. As of late, as the CPI is dropped, we would likely expect the Dow to drop as well. Compare U.S. CPI, the blue line, to the interest rate in the U.S. The Federal Reserve sets interest rates now at the 0 to 0.25%. Historically, as the CPI is strong, the Federal Reserve tends to raise rates. When the CPI is weak, the Federal Reserve tends to cut rates. Compare now the U.S. CPI, that's the blue line, to the PPI. That's the number that we received yesterday. CPI is Consumer Price Index. The PPI is a Producer Price Index. Yesterday we read that the U.S. PPI dropped to negative 0.1%. It is thought that if prices decline for the producer, prices will also decline for the consumer. As prices rise for the producer, they pass on the extra cost to the consumer. As the PPI has dropped, the CPI has now dropped, indicating that costs to the producer and the consumer are also dropping, and therefore we would likely expect anticipation of the Federal Reserve to raise rates not anytime soon, and we'd also likely expect to see weakness in the U.S. economy for the near-term future, and for the Dow Jones Industrial Average and other equity markets. With that said, if you have any questions, do not hesitate. Email us anytime, info@forexlounge.com. We thank you for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon. Back inside the Forex Lounge.